The top business stories live from the Sky News City studio. The Bank of England is expected to leave interest rates unchanged today. The decision will be made at noon. Government borrowed £8.4 billion in February. That was down on last year, but higher than expected. And healthy annual profits from Next, which says it expects to reduce its prices over the next 12 months. Good morning. This is Business Live with me, Ian King. The Bank of England's Monetary Policy Committee is expected to leave interest rates at their current level when it makes its latest policy decision at midday today. It would be the fifth consecutive meeting in which the MPC has kept bank rate unchanged. Bank rate has remained at 5.25%, its highest level since 2008, since August last year. Well, separately this morning, the Office for National Statistics said today that the UK government borrowed £8.4 billion last month. That was £3.4 billion less than in February last year, but it was higher than the £5.9 billion that the City had been expecting. It means that so far this financial year, the government has borrowed £106.8 billion. That's £4.6 billion less than at the same stage this time last year. Well, joining me now is Will Hobbs. He's head of multi-asset wealth at Barclays UK Wealth Management. Will, morning to you. No expectation of a change this lunchtime. What will you be looking out for?
You're right, Ian. There's no expectation of a change. I mean, I think, if you look at how the data is evolving, I think people rightly are getting a bit more confident in the trends in disinflation. Members of the committee have sort of obviously worried about those second round effects, and maybe the services component of the latest inflation release will still have them a little bit on edge or not sufficiently confident to do anything just yet. But I think mainly, what investors are looking for, just as they were with the Federal Reserve, is looking for the idea, is June, summer, right? Is there a chance of an earlier move from the Bank of England? And that really was where we're going to be passing information from the minutes and the sort of constellation of votes. I think those are the main things to look out for. And then there's going to be a lot of data between now and the summer that people are going to get much more interested in, I think.
Absolutely. You mentioned the votes there. We had a three-way split last time. A lot of expectations that it'll be a similar story this time around.
I think that's right. I don't want to be boring, but yes, I mean, we don't think there's probably enough in the data since then to sway. And if you've listened to the speeches since the last vote, it doesn't look like there's enough, certainly no one to join Swati Dengra in terms of the cuts. And, from our perspective, Catherine Mann looks quite entrenched. There hasn't been enough of a move in some of the things that she's said she's looking at to move her. So, again, a three-way split looks likely, but people will be watching very closely, obviously, if there is a switch, if any of those hawks rejoin the pack, that would be seen as quite interesting from a market's perspective.
Yeah, just to look at it from the hawks' perspective for a moment, Will, what are the main arguments in favour of raising rates from here?
Yes, it's interesting. I mean, the main worries, as you know, really are about the idea that, inflation is a psychological leech as such. The longer it hangs around, the more it risks leaching onto our subconscious and becoming entrenched in the economy. And that's always quite a difficult thing to gauge. You're sort of looking, because we don't know that we have inflation expectations necessarily, but I think the worry there is that the more that it's allowed to linger above target, as it still is, the more the risks increase. And they'll be looking at labour market data in particular and saying labour market for the most part. And as we know, that we've got a sort of quite an obscured read of the labour market at the moment, given some of the changes in the survey and the participation levels. But they'll be worrying that the labour market still looks relatively tight, and some of that services inflation could be construed as, maybe second round effects taking hold. And that would get, sufficient worries. And, these guys are put in place to keep inflation at the target level, and they're worried. They will continue to worry and have sleepless nights every moment it's not.
Yes, and on the dovish side of the argument, I mean, there is this theory that basically the bank needs to cut rates now, because if it doesn't do so now, it may be doing them too late in the future.
Yes, I mean, it's interesting this, and I think you can make the argument that actually because inflation is, falling away quite rapidly and your nominal interest rate staying the same, in a sense, monetary policy in itself is getting tighter. And so the worry there is that, your economy is not exactly booming at the moment, and you risk, as you say, given the lags in the policy system, which we've been very, this cycle has really demonstrated, are you going to get there quick enough? To a certain extent, I mean, the interesting thing you're seeing about the economy is it doesn't look to be collapsing. I mean, we know there was, statistically a recession in the second half of last year. But so far, if you look at today's PMI data, there's some signs of life. And also the consumer will probably, with that falling inflation story and the reasonably tight labour markets, you're getting increasingly or have been getting increasingly impressive real income growth. That's a force not to be underestimated. So our sort of outlook for the UK economy is probably a tiny bit brighter than some of the doomsayers out there. And actually, I think the reminder with the UK economy generally and all economies is that you don't want to mine the recent past too hard for what the future looks like. The next 10 years may look entirely different from the last 10, 15 years in terms of shocks and some of the other things that have depressed the growth rate. So be wary of using that recent past too hard, particularly as we're seeing this kind of new general purpose technology or batch of them arrive on the scene, maybe coming to the rescue in terms of productivity data, which is not necessarily in many forecasts.
Yeah, very good point you raised there. Well, since you mentioned the PMIs, I mean, the flash numbers today were reasonably encouraging. I mean, this is consistent with the UK having seen economic growth in the first quarter.
I think that's right, Ian. Yeah, I mean, and you're seeing it globally a little bit. Actually, far from wilting under the sort of gathering pressure of interest rates. Many of these economies have held in firm and are now starting to seemingly some of the cyclical aspects are picking up. And you're seeing that in some of the sort of early warning signals for global trade. You're seeing it even in the continent in Europe in some of the very early cycle stuff like chemicals. So actually, there are some signs of cyclical life out there that you're seeing in the UK PMIs as well. I mean, it's not, we don't want to get too excited just yet, but certainly digging beneath the surface of these PMI data for the last few months, actually, you've seen, even if the headline levels weren't that encouraging, some of the more predictive components, like new orders and production in particular, have looked a little bit perkier. So we'd be wary of being too negative and just would remind people that for the most part, you're meant to start looking at the economy by treating them as innocent until proven guilty. Growth is the norm, not the exception. Apart from, the experience of the last 10 years has probably lowered that expectation a little bit, but likely unnecessarily in the advent of this new technology and a new kind of investment cycle that seems to be kicking off with all sorts of sort of areas starting to benefit.
OK, well, got to leave it there. Good to see you again this morning. Thank you.
Good to see you.
Some of today's other business news stories for you now. And Next said this morning that it expects the selling price of its goods to continue to fall this year. The fashion retailer said that currently selling prices were down 2% on the same period a year ago, and during the second half of this year, they would be around 0.5% lower. Next also said that with UK wages rising faster than inflation, this would ease the pressure many consumers had felt on their cost of living for the last 18 months. Well, the company was reporting an underlying pre-tax profit of £918 million for the year to the end of January. That was up 5% on the previous 12 months and better than expected. The shares are currently ahead by 4.75%. Nationwide Building Society confirmed today it had agreed to buy Virgin Money for £2.9 billion. Confirming details of the takeover, first announced on a preliminary basis 2 weeks ago, Nationwide pledged to keep all of its existing branches open until at least the start of 2028 and said that would also apply to Virgin Money's branches. But it said that it did not intend for customers of Virgin Money to automatically become members of Nationwide for at least the first year after the deals had completed, although it said some could do over time. The deal is expected to be worth at least £400 million to Sir Richard Branson, who owns 14.5% of Virgin Money and who licenses the Virgin brand to the lender. The Virgin Money brand is likely to be phased out after 6 years. Direct Line said today it will resume paying dividends as it seeks to bolster its defences against a possible takeover. The insurer, which has just rejected 2 takeover approaches from the Belgian rival Ageas, also announced plans to reduce its costs by £100 million. Direct Line was reporting an operating loss of £190 million for 2023. That was up from one of £6.4 million in 2022, although at a headline level, it returned to the black following the sale of its brokered commercial business. Two of the UK's big quoted property companies this morning announced that they are tying the knot. Tritax Big Box REIT, which owns industrial warehouses to customers such as Amazon, is acquiring UK Commercial Property REIT, which owns supermarkets, warehouses, offices and some leisure complexes, in a deal valuing the latter at £924 million. The tie-up will create the UK's fourth biggest quoted commercial property company. UK Commercial Property REIT's non-warehouse and logistics assets are likely to be sold by the enlarged business once the deal has been completed. Well, the pound is a little drifty on the foreign exchanges ahead of the Bank of England's latest policy decision this lunchtime. Here's the current picture. Sterling off a third of 1% against the dollar, off by around a sixth of 1% against the euro. The single currency, meanwhile, off just over a tenth of 1% against the greenback. On the equity markets, following last night's gains on Wall Street, during which all three leading US indices finished the session at record highs, stocks in the Asia-Pacific region had a largely positive session overnight. That's a picture there, only the Shanghai Composite in negative territory. Here's the current state of play in Europe. All the main indices in positive territory just now, apart from the CAC 40 in Paris. Talking points this morning include Douglas, the German perfume and cosmetics retailer. That has floated today on the Frankfurt stock market. The shares have fallen by as much as 10%, however, I have to tell you. Meanwhile, the Swiss stock index, can't show it to you on the screen there, but I can tell you it's currently ahead by 2/3 of 1% right now. That is after the unexpected cut in interest rates today from the Swiss National Bank. Well, here in London, the FTSE 100 is firmly in positive territory, up nearly 1.25% just now. That is, in fact, a 10-month high right now on a very busy day for company results. The gains this morning on the back partly of some of those big dollar earners. In percentage terms, the leading FTSE gainer just now is 3i, the private equity company. Oh dear, we've got a Scott of Antarctic situation there. I can tell you 3i shares are up by 5.25% right now. That is on an investor briefing. To the downside, Reckitt Benckiser is off another 1.75%. This time last week it published results which did not go down terribly well. Those have continued to cast a cloud. Outside the FTSE 100, the gas producer Energean is up 2.25% on a strong set of results, but Computer Centre has declined by another 1.5% after its results yesterday. I remember telling you about those this time yesterday. In fact. As for the oil price, well, very strong start to the week, but it's unwinding some of those gains over the last 48 hours. A barrel of Brent crude will currently set you back $85.50 a barrel. That's off a little over 0.5% on the session. Well, joining me now is Alex Stewart. She's Credit Portfolio Manager at Schroders. Alex, great to see you this morning. Obviously, the big news overnight, the Federal Reserve keeping interest rates unchanged. That's expected, but it's all about the dot plot.
Yes, it's all about the dots, and it's all about how many cuts we're going to get this year versus next year. And the market was quite confident that we're going to see some cuts this year. Jay Powell did say that even though inflation has been a little bit bumpier than they were expecting, that they still think we're on the right trajectory.
Obviously, equity markets did very well overnight in the US. You're a bond specialist. What happened there?
Oh, the bonds were very happy with the news that we're definitely going to get a cut. I think there had been some question marks. There has been a lot of resilience in the US economy, and inflation has, it stalled a little bit.
Yeah, I mean, some people would say, why on earth is the Fed even talking about cutting interest rate? The jobs market is looking good. Consumer spending looks reasonably buoyant. GDP growth is pretty good. Why on earth would the Fed go?
Yeah, and this has been one of the questions, because obviously with the cuts being priced into the market already, financial conditions have loosened, and that's given a bit of a boost to the economy. But there was no mention of that. They were very much sticking to the line, and the dot plots hadn't, if anything, have changed slightly a couple of years out, but they're still saying they're on track to be able to cut, and stocks love that.
Yeah, I don't know whether you heard what Will Hobbs was saying a little earlier. He was basically saying, look, given the productivity changes going on in economies around the world now, the growth of AI and all the rest of it, is the past as reliable a guide to the future as once it was?
That's a very good point. It probably isn't. You know, there's been a lot of talk when we had quantitative easing. Everybody thought that was what was boosting stock markets. We've had quantitative tightening, and we're still getting rallying stock markets, and that's a lot been to do with the AI change. So, yeah, definitely there are changes going on to the economy.
Yeah, now closer to home, we got an interest rate cut this morning from the Swiss National Bank, which was right out of the blue. No one expected that today.
No, I mean, you know, we're expecting that the banks are going to start cutting rates this year. You know, inflation is falling, and that is the major thing that they're looking at. Obviously, the European economy has been weaker than we've seen in the US, and obviously for the Swiss, they thought it was enough for them to be able to start cutting now.
Yeah, worth pointing out that Swiss inflation is currently at just 1.2%, so well within the safety zone.
Absolutely, yes.
Yeah. Now, what about the Bank of England this lunchtime? As a bond investor, what are you looking at?
Well, it's much the same. I mean, we actually think that inflation in the UK will probably come down a bit easier than we've been seeing perhaps in the US. And given that the expectations of the same number of cuts this year, 3 this year, we would expect that the Bank of England are going to stay on that. And probably it's more likely that they're going to be able to realise them than maybe the US can.
Obviously, we had the public finances out this morning as well. Government borrowing a little higher in February than expected. Does that concern you at all?
Not particularly. I mean, we know we've got an election coming up, so we're expecting that there will be a lot of noises about cutting spending, but down the line.
Yeah, it was really interesting. In the budget speech that Jeremy Hunt gave, he praised Sir Robert Stamen, who runs the Debt Management Office. I mean, he's really one of the sort of unsung heroes of Whitehall over recent years, isn't he?
Yeah, I mean, they've done a good job in terms of managing to, you know, turn around the QE and start quantitative tightening without really causing much of an impact. So, yeah, it's nice to see the people behind the scenes getting a mention. So.
Absolutely. Alex, always good to see you. Thanks for joining me today. Well, it is a very, very busy day indeed today in the corporate world. Lots of company results out today. Let me take you through some of the other headlines now. And the fund management giant M&G said this morning it was on course to hit its financial targets for the end of the year after reporting better than expected results. The company, which has more than 5.1 million individual investors and more than 800 institutional clients, including pension funds and insurance companies, was reporting an annual adjusted pre-tax profit of £797 million for 2023. That was up 28% on the previous year. Well, M&G, which was once part of Prudential, said its flagship Pru fund attracted £6.3 billion worth of new money, which was its best performance since 2019. The shares are currently ahead by 1.5%. One of the biggest suppliers to the world's car makers warned this morning that sales this year are likely to be no better than last year's. Dowlais, which supplies drive system technologies to the likes of Ford and Toyota, said this reflected current industry forecasts, which imply a slight decline in global light vehicle production in 2024. The company, which was once part of GKN and which was last year spun off from the FTSE 100 engineering group Melrose, was reporting an adjusted pre-tax profit of £264 million for 2023. That was down 11% on 2022. The shares are currently off by 2.5%. And shares of Reddit will begin trading on Wall Street later today. The social media platform last night said it was pricing its shares at $34 each. That was at the top end of expectations, and it will value the business at $6.4 billion. That's less than the $10 billion at which it was valued at its most recent funding round in 2021. Well, Reddit, which won attention on Wall Street that year when it played a central role in the so-called meme stock trading frenzy, has offered a chunk of shares to some of its most prolific users. Well, still to come here on Business Live, I'll be speaking to the chief executive of Hostelworld, Gary Morrison, as the company sees more evidence of recovery in global travel. Don't go away.
It's unbelievable, actually, the change. I mean, before, you know, I could barely get out of bed. I couldn't really work properly. But it was, I think, even 3 days after the operation, when we were both lying in bed feeling quite sorry for ourselves in the ward and, you know, sort of wandering around with this massive wound. But in myself, I felt amazing. Like, you've suddenly got life back. You can actually, you know, get up and you want to do stuff.
The recovery took a bit of a while for me because I'm going from 2 working kidneys, obviously, down to 1.
Yeah.
And then it takes time for that one to pick up the slack. So it took a few months for me to get back to normal, but now I'm back exercising again and feeling good.
Max was really sweet. He was so keen to do it, and I was a bit hesitant because obviously it's putting a family member, through an operation just for your own benefit. And Max has kids as well, so it was a big moral conundrum. But he was amazing because he always said to me, "I'm really keen to do this. I want to do it. You would do it in my position," and pushed it. I mean, as a family, we've always been incredibly close, and we're still all very close. And I don't think it's changed anything between us, because
I think if anything, it makes you closer. Now you just have that inherent bond together that very few other people do. Obviously, there are other live donors, but it's quite rare and it's quite cool.
Yeah. So now I can ski. I mean, we went before the operation and I could barely breathe and, had to spend most of it in bed. But we've just been as a family the first big holiday since and felt so much better. I've got a new job now. I'm studying at university again. And actually, it opens up a future. Before it was a case of, how am I going to manage even living? And now it's, what am I going to do? Where am I going to go? I'm ready to crack on.
If you forgot your pajamas, Emirates has got you covered. Fly Emirates, fly better.
Welcome back. A bit of breaking news to bring you. The Defence Secretary Grant Shapps and the Foreign Secretary Lord Cameron are in Australia just now, and that is to sign further agreements under the AUKUS treaty, which was the defence pact announced 18 months or so ago by the United States, the UK government and Australia. Well, the Ministry of Defence has put out a statement this morning confirming that BAE Systems will be building nuclear-powered submarines for use by the Australian Royal Navy. That is in partnership with an Australian company called ASC. Now, it was kind of expected that BAE Systems were going to win that contract. What is interesting, though, is that Rolls-Royce has been confirmed today as providing propulsion systems for those nuclear submarines. So a boost for the Rolls-Royce workforce in Derby. More evidence of the recovery in global travel has emerged this morning with results from Hostelworld. The online travel agent, which is focused on the hostel market, said it had taken 6.5 million net bookings in 2023. That was up 37% on 2022, while sales rose by 34% to a record €93.3 million. Operating profits for the year came in at €5 million, compared with a loss of €13.6 million in 2022. Joining me now, I'm pleased to say, is Gary Morrison. He is Chief Executive of Hostelworld. Gary, welcome to you. Where have been the most popular travel destinations this year?
So thank you for having me. I think in 2023, you're absolutely right. Our net bookings were up 30%. And I think the biggest area that we've seen growth in the world is actually the lower price destinations. So South Asia, as an example, average bed price €10 a night, very low. That's up 2.5 times year over year.
I noticed in the statement you say net average booking value fell by 4% during the year. I assume that's because of a proportion of the sales mix. More people are going to these cheaper destinations.
100%.
Right. I mean, what proportion of bookings now come from, or are people going to Asia?
Probably about a third, actually. But it's, it's a very, very significant growth area. And indeed, in other regions of the world, like Central America or Latin America, Indeed, in Southern Europe, where the costs are sort of maybe €30 a night, we see really, really great growth year over year. And I think in the Northern Europe areas, if you looked at, London, Paris, Milan, or maybe, New York, which is up at the 50s and 60s in high season, the growth has been quite a bit more muted.
Now, obviously, your partnerships with hostels are all important to your business. You've launched something called Link-Ups, which enhances their offering. What does that involve?
So Link-Ups is a really interesting product because you've been hosteling, haven't you?
Oh, way back when, about 30-odd years ago now, Gary. Yeah.
But, the whole essence of the hosteling experience is people meeting other people. And in that vein, what we see with our hostel partners is they often have a very vibrant catalogue of events. It might be outdoor cinema with a bar, it might be day excursions, but they want a means to be able to market these events to a wider group of people. So Link-Ups is exactly that. It basically allows our hostel partners to load their event inventory on the back of our platform, and we publish that to everybody in the city, not just the customers who are staying in that property.
So, and that brings a benefit to your hostel partners. Would you necessarily benefit from that? Because potentially that's people who aren't necessarily booking with you, who are going to see this.
We publish it to all of our customers into the city. It is not a monetary benefit, and it's not the reason why we do it. We do it, as a way of signalling to the industry that we are very, very committed to its growth. But secondarily, it's all consistent with our mission. The mission of the company is help travellers find people to hang out with, and by giving them more opportunities in destination to go to these different events, we're able to deliver on that mission.
Yeah, so it's all part of the value add. What proportion of bookings now come via your app?
I would say probably shade over 40%. I think the bigger sort of statistic I would point to is if you look at the year-over-year growth, it's 49%. And that's a consequence of the business strategy where the social features, the ability to meet people in destination, all of the chat rooms, they're only available in the iOS app and the Android app. And as a consequence, far more people are downloading the app, they're using it on their travels, which is driving the 49% year-over-year growth versus the slightly less net bookings growth overall.
And very briefly, you're optimistic of further growth this year?
I'm certainly very optimistic. If I look at the first 10 weeks, I can see that our market share has risen year over year versus where it was last year. The trends are certainly good. We're feeling very excited about the year ahead.
Great stuff. I know it's a busy day for your results day. We do appreciate you spending the time to chat to us today.
Thank you very much.
That's it from me for now. I'll be back, of course, with our afternoon edition at 4:30, but don't go anywhere. Coming up in the next few minutes, the latest Bank of England decision on interest rates. Stay with us.
A very good afternoon to you. It is midday. In just a moment, the Bank of England will announce its latest decision on interest rates. As you can see here with me on set, our data and economics editor, Ed Conway. Ed, the rate is currently 5.25%. What's the expectation?
They've held it. I can tell you, it's just come through. They've left it on hold. This is totally in line with expectations. No one was expecting a change today. So 5.25% is where it stays. We're going to see, I guess, in a moment, which members of the committee, because what you have is 9 members of the Monetary Policy Committee. They vote on this decision. The interesting thing last time around, Wilf, was that there was a 3-way split. So one of the members, Swati Dhingra, voted for a cut. That was a big moment because it was the first time any of the members had voted for a cut. Then you had 2 members voting for an increase, and then the rest of the committee voting to leave things on hold. So the question this time around, and we're going to see this kind of coming through in just a moment. Actually, look, I can tell you, it was an 8-1 majority to leave interest rates on hold. And that one member preferred to reduce interest rates by 0.25%. So the 2 members who were previously voting for a rise in interest rates are no longer voting for that rise. So that's, in this kind of Kremlinology of looking at all of these decisions, looking at the statements, looking at what they're saying, looking at the votes and trying to get a sense of where they're heading. That is quite significant because you had 2 people who were pushing up. They're no longer pushing up. And actually, quite a few economists thought that the split might have stayed the same this time around. So in the scheme of things, that is what economists would call dovish. It suggests that they're kind of looking towards downwards rather than upwards.
And interestingly, they've done that while the inflation rate that we got earlier this week, which has continued to fall, was still quite a long way above the Bank of England's inflation target. They were seen as hawks that like to keep rates high. Even though the inflation rate's 3.4%, the target's 2%, they've already removed that sort of impetus to put rates further higher.
Yeah, they have. And so we had the inflation number yesterday. It was 3.4% rather than 3.5%, still above, as you say, the Bank of England's target, which is 2%. But even the bank itself thinks that those inflation numbers are going to come down. It's going to get towards 2% quite soon. But what's going to be interesting is just seeing, first of all, what kind of hints we get from the bank about when they are likely to cut. That's the question. The question right now is not, whether it's going to be up or down. The question is, when are they going to cut? And if you look at interest, actually, we can show you a chart of the rates as they've gone recently. If you look at where they are right now, 5.25%, a lot of economists think maybe it's going to be, outside chance of May, which is obviously the next meeting, but probably more likely to be August. But what's interesting here is looking around the world. So that, by the way, is the kind of
There's
recent...
a meeting in June as well.
There's a meeting in June as well, but typically they tend to do the big things, the big moves, when it's an inflation report. Not inflation report, it's called monetary policy report, when they do their forecasts, basically. So that happens in May, it happens in August. If you want to look back, actually, we've got another chart just kind of going back a bit further, just so you can see the kind of historic story here. The rates there with 5.25%, yes, they are lower than they were in the late 1990s, but as anyone who's got a mortgage and has refixed recently will tell you, it is still a very big shock, and actually particularly because people have slightly higher levels of debt right now, those people who have mortgages are struggling as a result of this. And so the longer those numbers stay high, the longer it takes for the bank to go down, there are many people who think, that in itself could propagate a recession.
So talk me through about how the 9 people vote, because 8-1. 8 today voted to keep them on hold, 1 for a cut. The prior 2 who had said that they wanted a hike have obviously now said hold. If we're only moving at that slow pace of people changing how they vote, it's quite a long way until 5 at least vote for a cut. But they do kind of vote in batches. 3 or 4 of them often vote together. Yeah,
and you kind of... what's interesting is that you often have a big shift when the bank does its new set of forecasts. And that will be kind of quite a big moment. So the next one is coming up in May. They do it every 3 months. They look at the state of the economy. And that just tends to be the time that they also tend to move interest rates. And, they can provide some context to it. There's a bit of background to it. Also, their minds slightly change because they're like, oh, this is what the model is saying right now. And also, we've had the budget, of course, and the budget is something that's kind of potentially pumping a bit of stimulus into the economy. So, but the main story here is I don't think anyone would be surprised about the fact that interest rates have stayed on hold. What's probably more interesting is that those 2 members, Catherine Mann and Jonathan Haskell, who were previously voting to increase rates, they're not doing that anymore. Last time around, the Bank of England governor said, the next move is going to be down. The question is kind of when. We are still none the wiser as to that when moment is coming.
But the drumbeat's got a tiny bit louder.
It's got a little bit louder, and I think whether it's May or whether it's August, it's coming, pretty soon. And that's the only question now.
Interesting you're saying May and August, because the market expectation before today was that it would actually come in June. It's a sort of probability-based thing, not a binary. This is what we're saying it'll be at this meeting. Let's talk about the market a little bit. Ed's going to stay with us. Ian King's also able to join us. Ian, a little bit of a slip there in cable in the British pound against the US dollar off the back of this change in vote?
Yeah, that's right. Sterling was around 1/3 lower against the dollar going into this announcement. It's now off by just under 1/2% lower. It's also slipped against the euro on the foreign exchange market. So, as you and Ed have both been saying there, definitely a tilt to the dovish side. Although, whilst you've been chatting, I've just been skim reading some of the minutes there. And it is very clear from those minutes that the Monetary Policy Committee remains very concerned about tightness in the labour market. They note that wages inflation is growing more rapidly still in the UK than it is in peer economies, particularly the United States. That's very much on the MPC's mind. And several times in the minutes, there are references to persistent inflationary pressures, and they make very clear in these minutes that the MPC will not be voting to lower interest rates until such time as these persistent inflationary pressures start to ease away and you do get back to the target rate. Now, in the minutes, the MPC, there are a couple of things they noticed. They expect a return to consumption growth in the first half of the year. They note, by the way, the spring budget, they think that will add around 0.25% to GDP growth in coming years. They have picked up on the indications that consumer spending is starting to recover. Now, we got those in the January GDP figures, of course. A lot of that was driven by retail sales. The Monetary Policy Committee also in these minutes note that mortgage approvals in January were at their highest level since October 2022. And of course, that was in the immediate aftermath of Kwasi Kwarteng's mini budget, which so rocked the gilt market. So the MPC very cognizant there, the fact that there is a lot of return to activity in the housing market. And that actually tallies with a lot of what we've been hearing over recent days and weeks from the housing sector. The likes of Rightmove and Zoopla both pointing out to a pickup in housing activity thus far this year. And even in, obviously, March is a very, very strong month for housing activity. That is something that has not gone unnoticed. And I would add to that, actually, Wilf, we had a trading update from Next this morning, who are very, very good readers of the macroeconomic picture. They're a few better than Lord Wolfson, the Next chief executive. And he was making the point in their results statement today that they see consumer pressures on the consumer easing from where they've been over the last 18 months, although they do point out that some people are still rolling off cheaper fixed-rate mortgages deals and will see money taken out of their pockets by higher mortgage payments. But I think that's the key thing I've seen so far in these minutes. The MPC still very, very concerned about wage inflation and really very cognizant and mindful of the fact that you are seeing this pickup in consumption activity and the housing market.
Ian, great stuff. Thanks so much for that. Ian King there in the city for us. Ed, just to wrap things up, I mean, talk to us about what this all means for the economy as a whole and where we are after that news, of course, in the late part of last year that we fell into recession. There was some other data out this morning.
Yeah, that's right. So formally, we are in recession, or rather, we were in recession at the last time we looked at that data, which was towards the end of last year, the final quarter of last year. But most of the recent statistics are suggesting actually the economy is doing quite well. Now, this is not official GDP statistics. It's the Purchasing Managers' Index is the one that came out this morning. It's a pretty good metric, though, of just how much activity is going on right now. And it was a little bit weaker than last month, but basically it's suggesting growth. So when you look at basically everything, it suggests we are no longer in recession. We have to wait till the numbers come through and we'll know that for sure. But it looks like we're no longer in recession. But on the flip side, for the Bank of England, that might, all else equal, make them a bit more wary about cutting interest rates, because the faster the economy is going, the more they'll think, OK, well, we don't have to be quite so worried. Worth saying, though, as Ian was pointing out, this is kind of their first assessment after the budget, and there was a line in there both saying that the budget was going to slightly increase the size of GDP, but also, and the Chancellor will be kind of very grateful about this, that inflationary pressures in the economy are likely to be smaller. So he was worried about, could I do anything that boosts inflation? It sounds like they're not so worried about that at the Bank of England. So that in turn means that the door is open, or ajar rather, for them to cut rates.
Ed, great stuff. Thanks so much. Ed Conway there for us as the Bank of England keeps interest rates on hold at 5.25%.